Good morning, everyone. My name is Matt. I'm one of the independent financial advisors here at Scott & Bland Financial Services Limited. Now, on the face of things, the budget yesterday didn't really announce a huge amount that's going to materially impact you or I as individual investors or savers. But there were a couple of things that were pre-released that are worth talking about, as well as a couple of bits and pieces from a wider economic point of view as well. Now, I don't think it came as any surprise to any of us that the Chancellor heavily focused on inflation yesterday. Last weekend, the quote on screen was announced, and ultimately I'm going to leave Luke Morris to do the wider economic update on inflation, while I'm going to look more at how it affects you and I as individuals and savers and investors. Now, on screen, what we've got is a chart comparing one of our core investment strategies for a medium risk investor against the CPI and the Bank of England base rate over the past 10 years. Naturally, you would always assume that an investment strategy should outperform CPI, and that's proved here. And if you focus in on around March, April 2020, you can see the crash caused by the COVID pandemic and then the subsequent recovery, with November 2020 actually showing from that point onwards, markets not only recovered, but have gone on to achieve higher growth than where they were before COVID. When you then compare the blue line, so B, which is CPI, with the Bank of England base rate, you can see that over that 10-year period, if you had held your money and only achieved Bank of England base rate, you'd have lost around 14% in total. Focusing that in on a 12-month period rather than 10 years, again, you can see almost 14% performance from our core investment strategy, and that compares to inflation at just over 3%, as the Chancellor announced yesterday, and the Bank of England base rate down at 0.1%. Now, it's all very well and good saying invest your money and you're going to beat inflation, but what you've got to actually do is make sure that investment strategy is suitable for you, and that's from a risk point of view, both now and moving forwards. And that's where we'd always expect and recommend that you use a professional financial advisor in order to help you get where you need to be. We should also point out at this stage, past performance obviously is no guarantee of future returns and can't be used as a reliable indicator for future returns either. Now, it's all well and good looking at things from a percentage point of view, but what does that mean in monetary terms? So we've run four forecasts here that assume £100,000, first of all, is held in cash at an interest rate of 0.5% per annum. And if over 20 years, inflation is bang on the government target of 2% a year, you're effectively lucky to have 75% of that original cash holding in 20 years' time. Factor in increased inflation of 3.5%, and you're looking at around 55–56% of that initial savings amount held by the end of it. So clearly you can see a reduction in the spending power of your money over 20 years. We can then have a quick look at potentially investing some of that money, and it's easy to turn around and say, well, let's invest the whole amount, but it's always important to make sure there is an emergency fund and there is money set aside in any financial plan to make sure you've got money there to cover anything that might go wrong. So we've assumed £80,000 is invested and £20,000 is held in cash. Again, that £20,000 will benefit from an interest rate of 0.5% a year. And for the investment return, we've assumed actual market performance over the past 20 years for the mixed investment sector on a balanced level of risk. Clearly, you can see huge potential upside here in investing some of the funds rather than sitting it all in cash, and you end up with £212,000 after 20 years. Increase the inflation to 3.5%, as we did on the cash example. You can see a huge reduction of about £52,000 there, clearly demonstrating the effect that high inflation can have, but also showing that investing the money puts you in a considerably better position if everything goes to plan. In terms of interest rates, as I said, we assumed a 0.5% rate in that previous slide, and we're well aware by this stage that the Bank of England base rate is 0.1% and has been for a while now. Looking at wider markets and open offers out there from the wider banking system, you can get as high as 0.6% at the moment for an immediate access savings account. But if you were looking to fix your money away for 12 years, you could be expected to get upwards towards 1.8%. That would typically be with a challenger bank rather than a high street bank, and there's a little element of additional risk involved in that. But if you then compare that to a 5-year deposit, for example, you would only get around 2% as an annual return at best. So there's very little extra reward for tying your money away for that extra 4-year period. Casting our mind back to the previous budget, the government announced that they were going to launch green bonds, and it's been incredibly quiet on this side of things up until this week. I suspect that's no coincidence with COP26 taking place this week as well, and I know Sam's going to touch on that in a bit more detail as well. The first of these green products to be launched by NS&I is a 3-year fixed rate bond with a 0.65% annual interest rate. That compares to the best on the open market of around 1.8%, as we've already touched on, and ultimately the difference between the two is partly the premium for going green, and also an element of reduced risk by the fact that NS&I are completely government-backed and risk-free compared to a challenger bank and the higher potential of them going bust further down the line. When it then comes to investment, historically the only real option to go green with investment was something known as ethical investment. And that typically involved screening out particular industries or trades you wanted no part in. That might have been fossil fuels, gambling, tobacco, for example. Whereas going forwards, what we've seen in recent years is more of a development on the sustainable side, where they look forwards and they want to apply and invest people's money in trades that are going to materially impact us going forwards and to have a positive impact on the environment, for example, green energy, electric cars. The list can go on that side of things. There's no right or wrong as to any individual's investment preference, and ultimately a lot of people take the view that in years to come there won't be any such thing as ethical investment, because if a company isn't actually acting in an ethical manner, it doesn't represent a good investment in any case. This is a conversation we've been having an awful lot with our clients lately, and we've got a wide variety of investment strategies available, both traditional, ethical and sustainable, to help cater to client needs. One of the myths or misconceptions is that ethical investment will cost you more money in terms of your annual charges and achieve lower returns. That might have been true 10 years or so ago, but it's far less the case now, as the chart on screen shows. This chart compares 2 investment options from one of the specialist third-party investment managers we work with, and this is over a 3-year period and shows outperformance by the sustainable portfolio of approximately 9% over that time period. That, coupled with the fact that their charges are virtually identical, to an extent debunks that myth, and it might even be the case that in years to come there'll be less of a difference between green bonds and normal bank savings accounts as well as that develops. So I did say it had been a bit quiet in terms of changes, but there are a couple of things worth picking up. The first of which is a temporary suspension to the triple lock on state pension. This is always a controversial subject, and typically the state pension will rise in line with the higher of 2.5% CPI or the average earnings. Now, as a result of COVID, furlough and the recovery and re-employment of a lot of the workforce, the earnings index is actually sitting at around 8%, and understandably government haven't wanted to increase state pension by 8% for everybody because that would cripple us, and therefore they've agreed to suspend that for this year. It will therefore be the higher of 2.5% or CPI instead. Graham's already touched on net pay pension contribution top-ups, looking to equalise those on low incomes where they could be in a relief at source scheme and be better off. That's estimated to be around £50 a year that's going to be topped up, and that starts in 2024-25. There was talk in the previous budget about a change to the pension charges cap in order to facilitate investment into different types of companies within the UK, both to give the option for higher investment growth for pension planners and also to inject funds into the wider economy. That is still very much under consultation, as announced yesterday. In previous budgets, there's also been a lot of talk about the pensions dashboard, which is a little bit like open banking, where you can see all your bank accounts on one app. The dashboard is designed to let any individual show all of their various pensions in one place, and that is currently on track and is due to be released in 2023. Obviously, a lot hasn't changed, and that's also worth picking up on. Graham has already mentioned a couple of these bits and pieces, and ultimately the message is all of these are still there, even though there was a lot of talk about removing them prior to the budget, as there has been in multiple years. Again, same story with ISAs, almost entirely unchanged, with no need to make any new plans, just a case of using those allowances. So your whistle-stop summary is inflation is high, interest rates are low. The only way to beat inflation is to invest money over the medium to long term. Make sure that investment strategy is suitable both at outset and reviewed on a regular basis, and make the most of your allowances while you can. I'll leave our compliance slide up for a couple of moments. Thank you all for your time this morning, and I hope you all enjoyed it, and I look forward to speaking to some of you in the breakout sessions. Thank you very much.